Let's jump into Chapter 3 of the Taxation Review. Now in Chapter 3 we looked at employment income. So if you're an employee, you will earn employment income. Now one of the big differences with respect to employment income is that employment income is included on a cash basis, not on an accrual basis. So that's the first thing we talked about. We also talked about bonuses. If an employee receives a bonus, there could be a difference between when the corporation that's paying the bonus gets to deduct that amount and when the employee needs to include that amount in their income. Now there's this 180-day rule. If the bonus is paid within 180 days of the corporation's year end, then the business gets to deduct that amount when declared on an accrual basis, and the employee gets to include that amount when it's received on a cash basis. Now, we also said that if the bonus is paid more than 3 years after the end of the year that it was declared, then both the employer and the employee needs to declare and report the bonus on an accrual basis. What about the situation when it's after 180 days, but before the 3 years? In that situation, both the employer and the employee treat the bonus on a cash basis. So once again, review those rules with respect to bonuses. We also talked about how do we determine whether an individual is an employee or self-employed? There could be a gray area, and so what the CRA has established is a set of guidelines, and it's through these factors that they evaluate to determine whether that individual is an employee versus someone who is self-employed. Moving on to the next slide, we talked about how do we calculate employment income. Well, there's certain things that we do not include, and these are basically non-taxable benefits. So if the employer has an RPP, a registered pension plan that helps their employees save for retirement, then if the employer contributes to the employee's RPP, that contribution that the employer makes on behalf of the employee is not included in employment income. So that's basically a tax-free benefit. Also, certain premiums paid on disability and group sickness plans are not included as well as a taxable benefit. So those are good things from an employee perspective. What about what's included? Well, if the employee gets any performance-related rewards, so any rewards based on maybe the amount of sales they generate in a year, that would be included in employment income. Any cash or near cash rewards. So a near cash reward would be maybe a gift certificate to Amazon that basically is the same as cash. So those are automatically included in employment income. What about non-cash gift? What about if an employee gets a gift basket full of food? Well, the first $500 in any year is not taxable. Anything above that $500 would be included in employment income. We spent quite a bit of time looking at automobile benefits. If an employee has use of a company car and that employee gets to take the company car home with them on evenings and weekends and gets to use it for personal use, then there's an automobile benefit that needs to be calculated. Now remember, there was two calculations. There's the standby charge and the operating cost benefit. So know how to do those calculations for exam purposes, and also know that there's a difference between the calculation for a car that's leased by the employer and one that's owned by the employer. Also, the last point on this slide, if the car is used greater than 50% for employment use, then there is a reduction available. Let's move on to the next slide and talk about low rate or interest-free loans. If the employer grants a low rate or interest-free loan to the employee, then the employee has to determine whether there's a benefit that has to be included in their employment income. Now, this benefit is calculated by comparing the interest rate charged by the employer to that of the CRA prescribed rates. Now, if the interest rate charged by the employer is below the CRA prescribed rates, then the employee needs to calculate this benefit. We also talked about the fact that if this loan was made as what we refer to as a home relocation loan, then there could be a deduction that is made when calculating taxable income. Now, the total benefit of this low rate or interest-free loan is added to employment income. Employment income is part of 3A when we calculate net income for tax purposes. If this is a home relocation loan, then there's a deduction that's made. Basically, the first $25,000 of the principal would be a deduction, based on the interest rate calculation, would be a deduction when we calculate taxable income. Now, the one thing to note is that this deduction for a home relocation loan, this first $25,000 of the principal that's tax-free, that is repealed from 2018 onward. So 2017 would be the last year for this deduction. Moving on, we talked about stock options. Stock options are basically a way that an employer could reward maybe certain senior executives and give them the option to buy stock in the company. Now, what needs to be done is that if the employee exercises the stock option, they need to measure their employment income inclusion. This would get added to their employment income. And this is measured only if they exercise the stock option. So when the date that they exercise the stock option, they take the fair market value that the stock is traded for minus their cost, and that difference would be included in employment income. Now, also when they dispose of the stock, there could be a capital gain or capital loss. Once again, this amount would be included in 3B, and only 50% of those amounts, the taxable capital gain or the allowable capital loss, would be included. Now, there could also be a deduction when calculating taxable income. The 50% deduction is 50% of the employment income inclusion. That deduction, once again, gets deducted when calculating taxable income. That employment income inclusion, the full 100% amount, gets included in 3A when calculating net income for tax purposes. And if the employee qualifies, this 50% deduction would come when they calculate taxable income. Now, in order to qualify for this 50% deduction, the option, when granted, would have to have been not in the money, or if the option was granted by a CCPC, the taxpayer held on to those shares for 2 years before selling them. Now, also, if the option was granted by a CCPC, that taxpayer would not have to include the employment income amount until they sell the shares. Otherwise, the employment income inclusion is included in the year that the stock option is exercised. We looked at specific deductions with respect to employment income. Now, most employers are required to sign this form T2200 before employees can make certain deductions. And we talked about that in class. There are certain deductions that don't require this T2200, but there are some deductions that do require their employer to sign this before the employee can make a deduction. Now, under 8.1i, professional dues, such as if an employee is a professional engineer or accountant, and that's a requirement of their employment, then that employee can deduct those dues when calculating their employment income. If an employee pays union dues, those are deductible as well. If an employee is required to work from home, and the employer signs the T2200, then certain workspace and home expenses could be deducted as well. Under 8.1h, travel expenses, for example, a salesperson might have to incur travel expenses, taking a taxi, flying to another city. Those travel expenses, once again, as long as they're required as part of their employment duties, would be deductible under 8.1h. Under 8.1h.1, that employee might have to incur motor vehicle expenses by using their own vehicle for employment purposes. Once again, if that's a requirement of their employment, that would be deductible under 8.1h.1. Now, the complication came when it came to commission salespeople. Commission salespersons have this additional amount under 8.1f. Now, 8.1f includes everything under H and H.1, but also many other deductions such as advertising, client entertainment, meals, only 50% of those are deductible, training, maybe certain licenses. However, if a salesperson wants to deduct under 8.1f, the amount that they can deduct is limited to their commission income. There's another constraint as well. If a commission salesperson wants to deduct under 8.1f, then they cannot deduct under H and H.1. Now, we talked about the fact in class the easy way to decide whether or not to deduct under F or H and H.1 is if the total under H and H.1, the total travel and motor vehicle, are greater than commission income, then it's better to deduct under H and H.1 and not under F. Now, once again, just a reminder, to make the most out of this course and to do well on exams, read the chapter and do the corresponding exercise and problems. That brings us to the end of Chapter 3.